Okay, good morning. Let's get started. Thank you everyone for joining us on our first webinar back after the brief summer hiatus that we've had. Hopefully everyone had a great summer. I'm Tom Citino, I'm VP Director of Member Relations, and it's really an honor to kick off today's webinar. Our Chief Business Officer, Adam Goldstein, had a conflict this morning and he wishes you all well. Today, we're featuring our financial economist. The title of the session, Beyond the Recovery Phase of the Economic Expansion. Brian Jones will be covering the road ahead for the national and local economies in 2021 and beyond. Also, if you feel like Brian would be a good fit to speak to your leadership team or your board of directors, please contact your relationship manager. Brian's always happy to attend those sessions and speak about the macro and also micro economies. We will be announcing some future webinars via email in the coming weeks, so please look out for an invitation. If you do have any suggestions or if you have any interests or speakers you specifically want to hear from, let us know. Contact your relationship manager, or you could leave it in the comment box on the webinar homepage. So just a few highlights of what's happening at the Home Loan Bank in New York. This Tuesday, on Tuesday, September 14th, $3 million in additional funds will be rolled out or be offered for these small business recovery grants. So we'll be offering members up to $100,000 a member, and members can offer $10,000 to qualifying small businesses and not-for-profit organizations which had suffered significant loss of revenue due to the pandemic. So that's this coming Tuesday, September 14th. Applications for the program round should be submitted on or after 8:30 a.m. On September 14th. Any applications received prior to that time, prior to 8:30, they'll be ineligible for funding, so and would have to be resubmitted. On Monday, September 27th, we're going to be launching an online system for our community lending program. So this is going to be enhancing the experience for those who are involved in our community lending programs. This launch is part of a continued effort to enhance the online capabilities to better serve our members. So the new system is going to eliminate the manual efforts to submit and manage CLP applications. So if you're a current community lending program user, please visit the CLP page on the public website for more information, and you'll see what the steps are for enrolling to get set up to use that new system. But it's a really nice platform. On May 3rd of this year, the 2021 Homebuyer Dream Program was rolled out. We had offered $15.7 million in grant funds. There are still some funds available that members are deploying, but for next year, those who are not involved in the Homebuyer Dream Program, the Homebuyer Dream Program offers down payment and closing cost assistance to lower income families up to $10,000, a grant of $9,500 towards the home buyer, and also $500 that could go towards the defrayment of homeownership counseling. So it's a great program. Everyone should be involved in that. And finally, before we start the webinar, we're continuing to onboard members onto our mortgage asset program. That's our secondary market outlet for our members to sell 1 to 4 family fixed rate long-term mortgages. That's a much improved secondary market outlet from what we had originally been offering under the NPF program. So if you're interested in learning more about that and setting up a one-on-one session, please contact your relationship manager to get that going. So if you have any questions pertaining to this webinar, please submit them at any time, and those questions will be answered at the end of the session. Also, if you have, we do have a survey at the end of the session that asks about topics and speakers that you'd like to hear from. Please input that information as well if you have some ideas for us. And now lastly, I'm going to turn it off to Brian Jones, our financial economist. So Brian, it's all yours.
Hey, good morning, everybody. I'm going to just dive right into the presentation here that we have up. Okay, 1 second. Okay, basically, we're going through, and we have been through, a very unique phase in our economic lives in the United States. For the first time in our recorded history, we've actually had a contraction in economic activity that was not caused by the usual factors. which would be industrial, monetary policy, tightening fiscal policy. This one was generated by a healthcare crisis. It was the sharpest business cycle downturn that we've had since the Great Depression, but it was also the shortest. Typically, recessions last around 13 months in the U.S. since the end of the First World War. This one just ended after just 2 months. Basically, the National Bureau of Economic Research decided that the economy basically bottomed in April of 2020. Since that time, we've been in the midst of an expansion. We lost a significant amount of real GDP as a result of the pandemic. We had 2 quarters of contractions. The first one was down 5.1%, but the biggest was the second quarter of 2020, where GDP fell at an annual rate of a little bit over 31%. It's taken us a year to get back to where we were before the malady struck. With the second quarter, the data came out. We basically had returned to a little bit above the aggregate level of real GDP that we had experienced before the contraction started. Where we are right now is it looks like we're in the midst of what should prove to be a pretty durable recovery, and we should essentially get back to the pre-pandemic trend line. I would say probably by the fall of this year. You can see that in the left-hand side panel here. That if you just eyeballed it and drew a line with your finger, we'd be back on that pre-pandemic trend line by the fall quarter of this year. As far as what we're looking for over the next year, it looks like growth is probably going to come in somewhere around 6.5 to 7% this year on a calendar year basis. We're probably looking for an increase of about 3% next year, and beyond that period, maybe about 2.5%. But the important thing to keep in mind here is that all of those projections out over the next, this year and the following 2 years, are above what most people consider the potential growth rate in the U.S. economy, which policymakers basically peg at 1.8%. For the most part, with the exception of labor market data and auto sales, most key economic variables are well above where they were before the recession started. Whether we look at core retail sales, we look at the ISM manufacturing and non-manufacturing indexes, we look at building permits or business capital spending, all of those variables are well above where we were before the pandemic struck. Anything that has to do with the labor market's had a tough time, basically because people, we've yet to return to full employment. We still have a ways to go to recoup the jobs that we lost as a result of the public health care crisis. On the auto sales front, the reason why we're behind there is that we have this ongoing chip shortage, which is constraining manufacturers' ability to produce new cars. And obviously, the inventories of new cars is very low, and it's also filtering into the used car market, where people are buying used cars in lieu of any other cars they can get. As far as the chances that we're in a recession right now, they're pretty non-existent. The guys at the St. Louis Federal Reserve Bank, Federal Reserve Bank of St. Louis, they've constructed a near-term recession probability gauge that basically rests on 4 factors: non-farm payrolls, industrial output, real manufacturing and trade sales, and personal income less transfer payments. That's essentially what the National Bureau of Economic Research uses to date business cycle turning points. And the latest data that we have, the probability that we're in a recession in July was about 0.1%, so negligible. The New York Fed has a model that's based on the slope of the yield curve between 3-month bills and 10-year notes, and it projects out what the chances are of a downturn a full year ahead. And right now, their latest reading is that it's about 9.1%. So right now, the probabilities of a recession over the next 12 months are pretty low. The most important thing I think that we need to look at right now, and this was all over yesterday's Beige Book, is we've got to keep tabs on the pandemic statistics that are coming out. Now, on the left-hand side panel here, you can see the United States numbers and our district. And we've done a much better job in getting shots in people's arms than the rest of the country as a whole. If you look at New York, with the exception of the Virgin Islands, basically over 65, around 65% or better of our populations have gotten the first dose. And if you look at New York City, and New Jersey, and Puerto Rico, we're actually getting up. We're approaching the 2/3 mark. Having said that, the fact that we've had this Delta variant outbreak, it has had an impact on activity. Yesterday's beige book from the Federal Reserve, which is a summary of regional economic conditions, there were at least 32 mentions of the Delta outbreak as having an impact on activity. And obviously, it's happening in areas we'd expect. What's happening is people are less inclined to go traveling, so it's hurting the travel industry, and it's also hurting anything that has to do with social contact, so going out to restaurants and hotels and the like. And you can even see it in the right-hand side panel here. I mean, we were gradually moving higher nationwide on the percentage of people that had returned to their normal place of work. Now, New York was always lagging the rest of the nation, the national average, by about 10 percentage points. In fact, our return to work numbers were actually the weakest, with the exception of San Francisco. But you can see that since the first week of July, once the Delta variant became more prevalent and people became more concerned with it, it looks like return to office plans have stalled, not only nationwide, but in our area as well. And with the latest numbers that came out, only about 21% of New York people that work in New York had returned to their normal place of work, and that's more than 10 percentage points below the national average. But these numbers are the ones that are going to be important going forward as we gauge the near-term impact of the Delta variant outbreak on the overall economy. Looking at the labor market, hiring did slow sharply in August. We created just 235,000 jobs, which was about a third of what was expected. But I think you've got to take that report in stride. First of all, no 1 month determines what's really going on in the labor market. The other thing, too, is that historically we've had problems with the August employment reports. In 9 out of the last 10 years, the preliminary estimate has been pushed higher with the following 2 months' reports. And even if you look at the response rates to the latest survey, only about 70% of the firms surveyed responded, which is below the average of the previous 5 years, which is about 75%. I think the problem that you have with August employment reports is that people were away for summer, and that probably affects the quality of the reports. But having said that, with the numbers that came out last Friday, we have gotten back almost 80% of the private sector jobs that we lost as a result of the pandemic. And we can see the industries that were hardest hit have made significant progress. Leisure and hospitality has gotten back almost 80%. Retail trade, almost 90% of the jobs. So we continue to make progress nationwide in putting people back to work in the economy. Turning to the breadth of job gains, and this is another reason why I'm not all that concerned about what happened in August. The Bureau of Labor Statistics also releases what we call diffusion indexes, which try to measure the job gains across the industries that are canvassed by government statisticians. All of the diffusion indexes, whether it's a 1 month span, 3 month span, 6 month span, they're all well above the 50 percentage point break-even mark, which is associated with stable headcounts across industries. The other thing, too, that I think makes me less concerned about the August employment report is when we look at what the wage numbers looked like in the last month's report. Wage gains were broadly based across every industrial sector in the economy. The aggregate gain was about twice what was expected by private sector economists. And I think what we do have is we are in an environment that, notwithstanding the weak payroll print, we've got extremely strong demand for workers. And you can see that in the right-hand side panel here, where I have the number of unemployed persons plotted against the job openings numbers. Now, the job openings numbers for July were reported yesterday. The number of positions available nationwide rose to an all-time record of 10.9 million. That was well above anybody's expectations. And right now, we've got a gap between the number of positions out there and the number of unemployed persons of almost it's a record 2.2 million gap. But the thing is, I don't think that does justice to how tight the labor market really is, because a lot of the people that are currently unemployed, my guess is they don't have the skills to fill the positions that are available right now. In fact, if you go through The text of yesterday's Beige Book report throughout the country, almost every Federal Reserve district talked about there being labor shortages in their areas. Looking at the household survey, this is yet a final reason why I'm not all that concerned about the non-farm payroll number. The household survey numbers were much stronger than the establishment survey numbers. The number of jobs, the number of people who found work in the last report from the household survey was about 500,000 people found employment. That was down from the prior month's 1 million, but it was almost double what we saw in the non-farm payroll canvas. Right now, where we stand, even with this morning's jobless claims report, we still have a ways to go. Even with the encouraging numbers we saw in initial claims for the latest reporting period, if you look at people who are collecting benefits under all of the various programs, the pandemic-related programs, it's a little over 12 million. And using the civilian labor force numbers for the month of August, we're about 7.6% of Americans are still receiving some sort of employment assistance. Turning to the other side of the Fed's dual mandate, inflation gauges are well above the 2% desired target, and they're likely to remain there for some time, even beyond the immediate future. Basically, the flare-up in inflation has been concentrated in 3 areas. Demand-related pickup in airline fares as people return to travel, higher prices for new cars because of the lack of computer chips to produce them, and thirdly, used cars, which are basically those prices being pulled higher by the fact that we've got a dearth of inventories of new models out there. Now, the latest report that came out for the month of July suggests that there was some cooling off in all 3 of those areas. So this flare-up in inflation may actually prove temporary, which is what the Federal Reserve expects. But just by the very nature of year-to-year calculations, year-to-year growth rates of core inflation measures are going to remain elevated for a considerable period of time. And basically, what we've got is what I guess people call a pig in the python problem, where it just takes a long time for these things to wash their way out. And even once we get into beyond next year, we're probably going to be looking at an inflation rate that is above the 2% target. But again, under the new operating procedures, the Federal Reserve has basically told us that they're willing to tolerate a period of higher than target inflation in the wake of periods where inflation's run much cooler than they'd like. Turning to financial conditions, this is certainly another tailwind that we have right now. Financial conditions basically are the most accommodative they've been in 3 decades. As you can see in the table on the left-hand side panel here, due to aggressive moves by both the Federal Reserve and Congress, the sharp contraction in financial conditions that we saw in March of 2020, we were able to essentially reverse it out by mid-September of last year. And since that point, financial conditions have gotten far more easy. Whether we look at narrower money market and bond market spreads, or we look at equity market prices or equity market volatility, all of these factors have contributed to the financial conditions being extremely accommodative right now. Turning to interest rates, believe it or not, are actually lower than where they were the last time we got together at the end of June. When we look at the Treasury yield curve, basically not only are rates down across the curve, but the curve's a little bit flatter than it was at that time. Having said that, the consensus is, though, that rates are going to move higher through the fall of next year, and basically we will end up with a steeper yield curve. So, for example, you're looking for maybe almost a 60 basis point increase in the 30-year Treasury, and about a 65 basis point increase in the 10-year note from where we are right now. And basically, the consensus is that this is going to be just a steady progression of higher rates through the fourth quarter of next year. We do have a Federal Reserve meeting coming up. Right now, at the end of this week, we'll be in the blackout period, so there'll be no Federal Reserve officials talking. But at the end of the September meeting, they will be coming out with updated projections, or what's called the Summary of Economic Projections. Given the data that we have in hand right now, they could lower their real GDP growth estimates for this year maybe a little bit, based on the fact that some of the indicators have gotten a little bit sluggish because of the Delta variant. There probably won't be much need to change their unemployment rate projections going forward or their inflation forecasts. But that's one side of the projections that they'll release. The more important one, and the one that will probably get the most attention from market participants, is what we call the dot plot, which is essentially what the 18 Federal Reserve officials think the median federal funds rate target is going to be over the next 2 years. Now, with the last meeting, basically there were no tightenings on the table in June. There was no tightening on the horizon going out beyond 2023. With the results of the June meeting, the first tightening did move into 2023. Basically, policymakers continue to think that rates will remain unchanged next year. But the one thing that I'll point out here in this dot plot is that we only need 2 Federal Reserve officials to get marginally more hawkish to bring that first rate increase into next year. So it's not a particularly high hurdle, given what the economic performance and inflation performance has been since the June meeting. Turning to the other side of the Fed's monetary accommodation, basically the Fed's been purchasing a ton of securities. Their holdings of securities are about almost $4 trillion above where they were before the pandemic started. There's been a lot of talk about the Fed tapering their purchases. Right now, they're buying 120 billion in treasuries and mortgage-backed securities per month, and there's more and more talk about them cutting back that rate of purchases. I think the problem is that when people talk about the curtailment of the asset purchase program, it's almost implicit that they're thinking that the Fed is going to go cold turkey on this, and chances are it's going to be extremely gradual. In the right-hand side panel here, basically what I have is the tapering that the Fed put in place in 2014. Basically, they were buying about 85 billion of long-dated treasuries and agency debt and agency MBS at the end of 2013. At that meeting, they announced that they would start to curtail their purchases pull back by about 5 billion per month. It basically took them all the way out until the fourth quarter of 2014 before basically the whole program had wrapped up. If they were to do it at the same rate, instead of having a 10 billion pullback at every meeting, under the current conditions, it would point the fact that they're buying 120 billion in securities would point to something a little bit larger, maybe on the order of 15 billion per month. But again, I think the important thing to bear in mind here is that this whole process is going to be very gradual. And if the Fed feels that they need to, they could just stop the tapering procedure as they go forward. Turning to the fiscal policy side, and again, these numbers in some sense are stale because we've yet to see them hammer out this $3.5 trillion fiscal package, which recently has been announced as going to a conference committee. That's clearly going to impact these numbers. Basically, what we have is we're going to have a tremendous amount of red ink at the federal level for the foreseeable future. This year's budget deficit, by the CBO's projections, is supposed to be about $3 trillion. It will narrow in 2022, but again, remember these numbers on the left-hand side panel here. They don't incorporate the latest fiscal measures. I mean, the infrastructure program alone is going to add about 250, 260 billion to the federal government shortfalls over the next 10 years. The important thing here from a market point of view, though, is that in the only unless there's a tremendous pickup in activity that we don't see, or they come up with some sort of really onerous tax package, the federal government's going to have to issue a fair amount of debt over the next 10 years to cover these shortfalls. And you can see that in the right-hand side panel here. But by the time we get out to the end of the forecast horizon, you're talking about Treasury debt being over 106% of nominal GDP. I mean, the numbers that are there based on laws that are in place right now. Turning to the housing market, housing's interesting because as much as some of the numbers have softened up, I would not characterize the housing market nationwide in any way, shape, or form as soft or even moderating. Right now, we are in an environment of historically low mortgage interest rates. You would think that given what mortgage interest rates have done, that we would see a significant pickup in home purchase mortgage applications. They peaked earlier this year, and they've basically essentially been going sideways the last 2 months. The problem is that the right-hand side panel, in some sense, is misleading, because what that should be plotted against is the stock of available homes on the market. And right now, whether you look at our area or you look across the country, there is essentially nothing out there to buy. I mean, the housing stock right now is at an all-time low across the country, and we've got severe shortfalls in our own area. As you can see in these charts here, on the left-hand side, we've got the national numbers. They have just started to bounce off their all-time lows. Homes available for sale in a month supply measure. If you look at New York and New Jersey, however, our inventory situation is severe. The latest data that we have from New York and New Jersey is through July. The stock of available homes across the Empire and Garden States was down about 22% over the latest 12 months. In New York, we're down about 19.5%. The inventory problem is really severe in New Jersey. The stock of homes available for sale in New Jersey is down about 25.5% over the latest 12 months. So even though there's some signs that we may have bottomed nationwide, there's no signs of that in our own area. Now, builders had started to respond to the lack of homes on the market. We have had seen some significant increases in single-family home building permits. But the problem is that over the last few months, they've started to falter. What's going on here, I think, is it's not that builders don't want to build, they're not willing to build. It's that there's a variety of shortages that are impacting the ability to build. One is available labor. The second is available supplies. And even simple things like appliances. I don't know if any of you have recently tried to purchase a dishwasher or a refrigerator, but it's taking now almost 2 months before you can get home appliances. And I was looking at some blurbs from builders nationwide. Almost all of them are talking about the fact that it's not just labor, they just can't get the materials to build homes. And so, for example, while it might have taken like three months to do something, now the lag is taking almost 6 months. So I think that's what's impacting building permits in our area. I mean, there's no sense getting permits if you can't actually construct the home. Looking at the near-term picture for home sales, I think nationwide, this is in the left-hand side panel, I think what you're going to see is the nationwide, existing home sales are basically going to tread water. Somewhere probably between 5.5 million and 6 million units at a season-adjusted annual rate. The picture is a little bit better in our area because basically we have, for some reason, the gap between going from a contract signing to a closing has been taking longer than usual in our area. Typically, it's about 1 to 2 months. It seems that it's been a bit longer. And with the latest data that we have available, pending home sales or contract signings, we're still well above closings. So we probably have some ways to go in coming reports. Even if you look at the anecdotal stuff that was in yesterday's edition of the Beige Book, I mean, basically contacts were telling Fed officials that the housing market is exceptionally firm in their district, which is essentially our district. It's not as firm in New York City, obviously, for reasons that people are not aware. But it's exceptionally firm in other areas of our coverage area. And because of that, given the limited supplies, the month supply of homes on the market in our area is obviously very weak. But because of that, homes are changing hands at a record clip in our area. Whether you look at New York or New Jersey, the number of days on the market when a home goes up is fallen sharply, and they're near record lows. If we look at New Jersey, you're almost just a little bit north of 30 days. In New York, you're a little bit north of 40 days, going from a contract signing to a closing. So again, it's not taking long for homes to go. And what's also happening is you're seeing more and more stories about bidding wars for homes in our coverage area. And that's surprising given the fact that we've had a fairly massive increase in median selling prices. Over the latest 12 months, median prices in New York and New Jersey they're up about 25%. In New York, they're up almost 34% median home price. New Jersey, about 19%. The median home price in New York now is $374,000. New Jersey, it's higher at $390,000. But you can see how hot the market is in the right-hand side panel here. Sellers are getting well over listing price across both New York, across both the Empire and the Garden States. Both local realtor associations have been reporting that homes are changing hands at about, somewhere on average about maybe 101, 102%, 1 to 2 percentage points above their listing price. The one thing that I think is really interesting, and obviously, colleagues of mine point out the fact that all housing, all economics is local. What you think of the economy really is a function of where you're sitting. And you can see that in these two charts here, where basically on the left-hand side, I've got nominal home prices, and on the right-hand side, real home prices for a variety of areas within our district. And you can see that the price performance, it can be dramatically different. For example, over the last year, price increases year over year have averaged in nominal terms, in the double digits. The weakest home prices were in Nassau and Suffolk County, up 14%, whereas Camden, New Jersey, has reported a 22.8% increase over the last year. And if you look at the 3-year average numbers, which I think are more instructive, the best performing area within our coverage area has been Buffalo, Chautauqua, and Niagara Falls, where the annual rate of home prices in nominal terms has been up almost 11% over the past 3 years. I always point out that you really do need to look at real home prices, because the prices of everything goes up through time, and it's not fair to just look at nominal prices. I mean, the lines don't change all that much as far as ordering, but you can see that even though we are at historic highs, well above our pre-financial crisis highs and nominal prices, that's not necessarily the case when we adjust the numbers for inflation. And I think, when you talk about a housing bubble, those are really the numbers you want to look at. But when you look at the real home price numbers, I mean, some of them are, most of them are not above their pre-financial crisis peaks. And a lot of the areas never experienced the boom and bust that other areas within our coverage area did. So, for example, the upstate New York areas, they never saw the blowouts in home prices that other areas of our coverage area did. So you've got to be real careful when doing those. And also remember, this is against a backdrop in which there's essentially very little housing stock on the market for consumers to purchase. Looking at mortgage performance continues to improve, although we're still above the levels that were recorded before the pandemic. I mean, foreclosures nationwide are at their lowest since the final quarter of 1981, and basically the nationwide delinquency rate at about 5.5% is the lowest since the first quarter of 2020. In our area, though, both the delinquency rates are significantly higher. In New Jersey, in the second quarter, it stood at 6.2%. In New York, 7.2%. Now, those are pretty sharp improvements from the 11% peaks that we essentially experienced. But again, New York and New Jersey had the third and fifth highest delinquency rates in the second quarter across the 50 states. So we have to bear that in mind. And as far as New York City is concerned, even though the delinquency rate improved from 5.6 to 5.4%, we're well above the 2.7 that we experienced before the pandemic hit. As far as forbearances, they continue to improve, and they're likely to improve as more and more people are put to work. Basically, the forbearance growth rate is at about 3.2%. The peak in the midst of the healthcare crisis was 8.6%, and the total number of people in forbearance now is 1.6 million, which is down significantly from the 4.3 that we experienced at that time. Looking at non-residential building projects, it looks like they've taken a breather over the last 2 months. These are plans for new institutional and commercial building. You can see that in the left-hand side of the panel here. These numbers are from Dodge Analytics. we basically average about 11 projects per month that are worth $100 million or more. And with the latest numbers, we're a little bit below that as far as the month of July is concerned. Again, I'd like to see the numbers going forward to see if this is an ongoing trend that we need to be concerned with, or it's just a temporary blip, because you can see in the left-hand side panel here that these projects and lending numbers can be very volatile on a month-to-month basis. When you look at commercial real estate in our area, you have to be real careful. You really need to segment it into three areas. You've got the office market, the industrial market, and shopping centers. Now, the office market, basically anything that's near New York City is having a tough time. The net absorption rates are extremely negative. The vacancy rates have risen since the pandemic hit. The asking rents have fallen. However, when you look beyond the New York City area, the numbers, while not great, they're a little bit better, especially for things like asking rents, and the increase in the vacancy rates haven't been high. The industrial market is firm throughout our district. And I guess that's, what I would call the Amazon effect, that you need more warehouses and things like that to process goods that are going out to people. And you can see that pretty much across the board, net absorption is positive. More and more industrial space is being picked up. Vacancy rates have fallen sharply across most areas, particularly those beyond the New York City metro area. And asking rents have been pretty firm. The shopping center market is mixed. Even though net absorption is negative and the vacancy rates have climbed, the asking rents have actually gone a little bit higher in most areas, with the exception of the New York City metropolitan area. I'm just going to turn briefly to bank lending, because I think these numbers are pretty interesting to look at. With the latest senior loan officer opinion survey out of the Federal Reserve Board, basically throughout their survey, there's a net, the percentage of banks reporting tightening standards for virtually every loan category was negative. So basically, the banks are essentially easing standards across every loan category. What we have in this chart here is we've got the net percentage of respondents reporting tightening standards for C&I loans, whether it's large or medium or small banks, and the bottom panel is tightening standards for commercial real estate loans. And you can see that pretty much all of the lending standards have eased by size of bank for C&I loans and across the various CRE loan categories. The interesting thing there too is that pretty much all banks were reporting a pickup in demand for borrowings, whether it was C&I loans, or if you look at the lower right-hand side panel there, construction and land development, non-farm, non-residential, and multifamily demand has picked up significantly. In fact, multifamily demand is at an all-time high over the course of the period that the Federal Reserve has data. Turning to mortgages and consumer loans, with the exception of subprime loans, pretty much all lending standards across various loan types for mortgages eased with the latest survey, and we can see that also, with the exception of subprime loans, the demand has actually improved. Is actually net positive across most loan categories. That's in the upper right-hand side now. If we look at the lower left-hand side panel, basically lenders have eased terms on all sorts of consumer loans, whether it's credit cards, auto loans, or consumer loans, ex-autos, and credit cards. Those standards have eased, and there has been a significant pickup in the demands for such loans, in particular for credit cards and autos, with the latest survey that came out. So, I mean, we've got a combination across all these four lending categories where banks are easing standards in an environment in which demand is very solid. Turning to our area, which is a little bit different than the rest of the country, we're still having a tough time recouping the jobs that we lost as a result of the pandemic. I mean, in some sense, this data dovetails with those return to office numbers that we spoke about earlier. But the latest numbers that we have for our area through July, we'll get the August numbers a week from tomorrow. New York, New Jersey, Puerto Rico, and the Virgin Islands. But you can see that we've gotten back about 58% of the jobs in our area since the trough of the business cycle downturn in April 2020. I mean, Puerto Rico's actually had the most success in getting positions back compared to New York and New Jersey. In fact, without the Virgin Islands, New York's only gotten back a little over half the jobs we lost. The reason why we're lagging everybody else in the country is essentially a compositional problem, and that's in the right-hand side panel here, where we've got private payroll changes in our district by industry. And the problem that we have is that we have a lot of our economic activity and headcounts are concentrated in areas where there's a high degree of social contact, things like leisure and hospitality, education, health, and business and professional services. For example, in our area, we've gotten back only about 57% of the jobs that we lost in leisure and hospitality, and only a little bit over 60% of those in professional business and services and education and health. Now, these numbers should improve as more and more people in our area are vaccinated, and we do, return to office plans are reinitiated. But again, it looks now like it's going to take a little bit longer than we may have thought before the Delta variant outbreak. You can see, as I said before, when we were looking at home prices, the behavior is very different depending on what area of the home loan bank in New York's coverage area you look at. The same is true of employment. You can see it in the numbers at the top. I mean, the U.S. has gotten back about 3/4 of the jobs lost as a result of the pandemic. We've gotten back 58%, so we're well below that. But you can see even within our area, when you segment the data out, I mean, areas that you would think are going to be lagging are lagging. In New York, we've only gotten back about 43% of the jobs lost. Sorry about that. And it's the same is true if we look at unemployment rate statistics, which is from the other survey, the household survey. You can see that for our coverage area and each of the individual segments, unemployment in our area is running about 2 percentage points higher than the nationwide average. So that dovetails with the fact that we've had a much more difficult time getting jobs back than other areas of the country. As far as inflation in our area, that there is some good news there, is that at least price increases in our area are actually lagging behind those of the nation as a whole. The CPI in our metro area is running around 3.5%, which is about 1.5 percentage points shy, almost 2 percentage points shy of the national average. And even if we look at core prices, which exclude volatile food and energy components, we're also running well below the national average. And the major factor behind this, because it has such a heavy weight, it's the shelter cost price increases have been much weaker in our area than the nation as a whole, basically a full percentage point below everybody else at about 1.8%. The latest data, which goes beyond the employment reports survey month of July, which we just talked about, are for August, and the manufacturing numbers remain very solid in New York State. Not only are we deep in expansionary territory as far as business activity, new orders and employment, which we can see on the left-hand side panel here, but I think the important thing here is that firms remain exceptionally optimistic. Manufacturers in our area remain exceptionally optimistic about the future activity over the next 6 months. The same is true for service-producing firms in our area, and this is important because so much of our activity is concentrated in the service-producing area of the economy. Business activity took a breather in the month of August as far as the growth rate, but percentage of firms reporting an increase in activity, less those reporting a decline, is deep in expansionary territory. And the other thing, even within this report, even though we're lagging the rest of the nation, reports of higher wages for service-producing workers locally are exceptionally strong. And like manufacturers and service-producing firms in our coverage area, they're very optimistic about what the future holds. Again, this all depends on how quickly we can get shots in people's arms, so we can, get better control on this Delta variant. And that concludes my presentation. And with that, I'd be perfectly happy to try to answer any questions you might have.
Hey, good. Thank you, Brian. There's a couple of questions. The first one, Brian, you had showed a yield curve that would be steepening going out into the fourth quarter of 22. Currently, 10-year Treasury is around 135. Consensus estimates look like it's going to get up to 198 in Q4 of 2022. However, you also mentioned that core inflation will remain elevated for extended period of time. At what point do you think the Fed would act to raise short-term rates? And then the follow-on question is that when do you see us getting into a more normalized rate environment, or is this the new normal?
Well, I think the Fed is a long way from raising administered rates, regardless of what the dot plot shows us. Okay, because remember, there's a wide gap around the median. Half the people are above, half the people are below the median forecast. The other thing that I think prevents the Fed from raising interest rates precipitously is the fact that when you look at more and more of their public appearances, there's more and more talk about a more inclusive economy, a more inclusive economic expansion. And I think the backdrop, what that's basically telling you is that the Fed is willing, in the unemployment inflation trade-off, the Fed going forward, because of social reasons, is probably more willing to tolerate faster inflation if basically they can get lower employment. And basically, it's sort of kind of a rising tide lifts all boats. And if you look at the last employment report, they still have a significant amount of ground to make up when you look at specific segments of our population, Black or African Americans, Hispanic Americans. Their unemployment rates are elevated relative to the overall average. As far as a normal interest rate environment, I think it's going to take some time because remember that nothing ever goes in a straight line, and I think this Delta variant outbreak it's at least giving people pause about if not the durability, the pace of the expansion, because you are seeing more and more people as a result of what's going to happen because of the Delta variant are marking down their Q3 numbers. And that's basically kind of a mark to market because the numbers that we have in hand have been on the soft side. I mean, for example, the guys at the Atlanta Fed, who I think do the best job of doing mark to market or tracking estimates for real GDP, they've got third quarter growth right now at 3.7%. A week ago, it was about 5.25%. You've got other big houses that have marked down their numbers as well. So it may take a longer period of time for us to get that interest rate environment. I mean, the only thing that I also would bear in mind here is that even if we do get a slowdown in the third quarter, if we can get a handle on this quirk on the public health care front, you could see pent-up demand in the fourth quarter or forward. So basically what you're doing is you haven't extinguished economic activity or spending. Basically, you've just deferred it.
All right, thanks, Brian. This next question goes back to talking about how housing starts, and although there's an uptick, permits aren't really being applied for because of lack of supplies. So what's driving the lack of supplies for home builders, and when do you believe challenges surrounding obtaining materials will subside?
Well, I think a lot of it's supply chain problems. Remember that you have a lot of people that have yet to return to work, so you don't, I mean, basically you're putting tremendous demands on shippers and things like that. If you look at vendor delivery numbers, whether they're in manufacturing or service producing surveys, delivery times are exceptionally slow. And again, it's in some areas they don't even have the material to complete the homes. Evidently, in a lot of areas of the country, believe it or not, they're having a hard time getting windows. And here's the rub there. I was reading one person's comment where he said, look, all the electrical work is done, but the people that certify things in our area, they're not going to clear us on the electrical work until we have windows in the home. And there are other areas, and again, I don't know if you folks have purchased any appliances recently, but I did. I bought a new fridge and a dishwasher, and it took around 2 months to get them. There's not a quick turnaround on appliances, and I think that's going to take some time. These are supply chain problems that need to be worked out.
Okay, and a follow-up question of mine, Brian. The housing housing prices are elevated, although adjusted for inflation, they're not above peaks experienced prior to the pandemic. So therefore, you don't see a bubble. You don't see that a bubble exists in the housing market right now. What if supply chains remain challenged due to some new variants of the COVID virus? How do you see that a bubble could form in the future?
Well, I mean, here's the question: is what do we mean by a bubble? I mean, do we? I mean, is it that we're just going to see? I mean, as they say, the cure for high prices is high prices are higher prices. At some point in time, you'll get to a point where people just won't be willing to step in anymore. I mean, I don't know if we're there yet, because again, I mean, if you look at, that's why I think you have to get away from looking at the sales statistics, because the sales statistics are being capped by supply. I mean, I think what you want to look at is you want to look at, number of days on the market that a home is spending, percent of listing price that people seeing. I mean, I think, a sign to me would be if you were getting these really steamy numbers in an environment in which the housing stock was picking up appreciably, or there was a boatload of building going on. But that's just not the case. And the problem is you got a demand curve that's moved. You've got a demand curve that's moved to the right, and you've got a supply curve that's kind of stuck in the mud.
Okay, gotcha. Thanks, Brian. So that concludes the questions, Brian. We really appreciate you taking the time out to speak to all of us today. Again, as a reminder, if anyone's interested in Brian speaking to their leadership at your organizations or to your board, please feel free to reach out to your relationship manager on that. And also, please leave comments and if you have any suggestions for future topics. So that concludes our session. We will be sending out an email within the next several weeks to talk about some upcoming webinars that we will have. But thank you, everyone. Have a great day, and I'll see you next time. Thanks, Brian.
Thank you.